Carla Fernandez, thanks for joining us today on Market Call. Richard Orrell is on the show today, portfolio manager at Croft Financial Group, taking your questions on exchange-traded funds. Here's how to reach us, 1-855-326-6266. You can also email us, marketcall@bnnbloomberg.ca. Richard, thanks for joining us in-house today. A lot to talk about. I do want to start with all of the craziness on the markets. We have the TSX down several hundred points, the NASDAQ down by, I think last time I looked, 650 points. Is it mostly tariffs people are reacting to, or is this just panic in general?
Well, I don't know if we're at the panic stage yet. Market is digesting all this news, tariffs, AI and where that's going as well, economic and other foreign policies by the U.S. administration. So that uncertainty just breeds this volatility. I don't know when this bout of volatility is going to be over. No one really does. The U.S. administration seems to have the memory of a goldfish, right? One day it's on, one day it's off with these tariffs. We don't know what's going to happen. But what I'm looking for, I guess, is some of this capitulation. So a day like today, if we can see some lows put in and then maybe some buying back later in the day and a sequence of that happening, that would be an indicator that the bottom may be near. Of course, all big corrections start as small corrections, but that's what I'm looking for.
You're also seeing signs that consumer spending is slowing down. What are you looking at?
Yes. So the consumer has been very resilient all through 2023, 2024, really powering this market. You have another guest. He comes on every once in a while named Ryan Dietrich. He's been on that case for quite a while. But now we're seeing that shifting. Definitely a concern going forward. And we'll have to keep watching that data as it rolls out.
Okay, let's talk about where to move your money in situations like this. As you mentioned, big drops start with small drops. People don't know where we are in that downward slide. So what are you advising investors at this point?
Well, it really comes down to asset allocation, and a lot of it's an individual conversation. So for my clients, I prepared a little bit for this. I took some of the volatility out of the portfolio. Not perfect, obviously. Can't always time the top or the bottom, but try to protect them. So as long as you know that you have whatever money you need, and some of those conversations are, hey, Richard, I want money for the next, even 3 to 4 years to be very, very safe because I need that to live off of. That's where we've been having those conversations, making sure that portion's safe. On the other side, you need to protect your portfolio and your wealth against inflation, cost of living, increases like that. So you need that equity component on the other side because there will be brighter days ahead.
Okay, so if you are sort of living off, you're in one situation. If you're 5 to 10 years from retirement, you're in a different situation. If you're much younger than that, you have a lot more time to play with. Yeah,
exactly. So, depending on your situation, if you're younger, you actually want to embrace an opportunity like this, right? So I think, in the big scheme of things, we're back to prices in, say, September, October level, which, yeah, it's a setback, but it's not that bad. But if you're younger, definitely, if you have the capability to, double up on some contributions to whatever you're trying to do to meet that goal or retirement goal, you want some of this downdraft in the market to be able to do that.
Yeah, now's the time to do it. All right. Thanks for that. Richard Orrell is joining us, portfolio manager, Croft Financial Group, taking your questions today on exchange-traded funds. Here's how to reach us. We're back in a moment. Welcome back. Thanks for joining us here on Market Call. We're taking your questions. We're going to begin with an email at this point. Troy wrote in. Here's what he wants to know about Invesco Triple Q Trust Series 1 on the NASDAQ. Want to know your thoughts on 2025 outlook.
Well, this is a tough one, right? So we're seeing the growth space taking the biggest drawdown here, right? So that economic growth is what's being put into question by these tariffs. We have seen rates on the other side, expectations for rates dropping in the U.S. Increase. So again, it's back to time frame. So if your time frame is much longer, I have no problem holding the QQQ. It's a main, technology has a lot of tailwinds behind it.
Okay.
It's part of our everyday life. And so if it's an opportunity to add in a long-term account, I'd be looking to add as it, drops.
Okay. So if you have that timeline, if you don't?
If you don't, again, you have to be prepared. Like NASDAQ has had a few very large drawdowns, 30, 40%. Tech bubble, obviously, financial crisis as well. COVID didn't get that bad, but there's a very fast rebound. So you just have to be prepared for that volatility. Does that work in your portfolio? Is that something you're comfortable with?
Okay, let's go to the phones. Rob's on the line. He's calling us today from Calgary. Hi, Rob. What's your question?
Hi. Thanks for taking my call. I'd like to hear Richard's opinion on HMAX, Hamilton's Canadian financial ETF. Would you recommend this this ETF for an investor primarily looking for income? And if not, can you offer a better alternative? And also, do you buy these ETFs on dips? I mean, in general, they seem to trade in a pretty tight range, and I assume because they're buying call options at the money and getting called away, or do you just get in at the market because you're not really looking for growth?
That's a very good question.
Yeah. So Rob, as far as the financials, I use a few different instruments for it, but HMAX seems fine. The one thing I always look for is if it has any leverage component in it. I'm not a proponent of leverage at the product level, and also usually not at the portfolio level. It's a more advanced strategy. You got to make sure you're very comfortable with it. But yeah, if they're writing calls, then yeah, that's providing a bit of insulation. ETFs, for the most part, although they're proliferating and there's many more, do provide some of that more comfort. You're using diversified baskets of securities and not single securities where you can have some severe drawdowns. So they do help mitigate some of that risk. I would be fine with the financials in a portion of a portfolio. If we're talking about 100% equity, I wouldn't ever go more than about 10% on a single ETF of that nature, of a sector bet.
He also wanted to know whether you should wait for a dip to buy in. Is it even worthwhile because they're not hugely up and down?
Yeah. I mean, timing. We love to all have perfect timing. It's not. There's no science to it. I can't tell you when it is. If you have a dip, obviously it's a good opportunity to buy. It's like the grocery store, right? I'm a bit old school. I still go through the flyers.
Yeah.
And what's on sale? Hey, blueberries this week. I'm going to buy some blueberries.
Stock up in that.
Yeah. Next week it's strawberries. I'm going to buy some strawberries.
Got it. All right. Let's go back to the phones. Joe's on the line, calling from Montreal. Hi, Joe.
Hi. I want to ask your guest about two ETFs. I'm a retired senior looking for income. I wanted to know about his recommendation of the healthcare harvest leaders, HHL, versus the ZWU utilities ETF for BMO. Both of these are kind of ETFs you would hold in maybe an environment that we're in right now where stocks are up and down, and I'd like his recommendation for my particular age group for revenue, what he would recommend in that situation. Thank you.
Can you differentiate between the two?
Well, obviously at the sector level, you can differentiate.
Yeah.
Utilities are relatively safe sector, all right? All the prices are usually fixed and contracts and things like that. So companies have a lot of clarity there. Healthcare is a bit different. But again, fairly stable, obviously playing into the demographics of what's going on as well. So I can't really make a call on either one. I would, likely just add both, right? Just split it. If you're having a hard time making a decision, just split whatever allocation you're going to do and add both to the portfolio.
Got it. Okay, let's go back to the phone lines. Renata is on the line, and she's calling us today from Oakville, Ontario. Hi, Renata. What's your question today? Renata, are you there? Okay, so I believe she had a question about ZWE.
Okay, so I understand ZWE to be a Europe-based ETF. Okay.
Is that better right now? considering North America's where it is at with all the uncertainty?
Well, Mario, that's a good question, right? So, and that's something that is, I'm working on in my brain, because if the U.S. markets are often the leader of what's going on in the world, and we've seen some pullback in that market, and then you've got Europe going up. If the world was headed towards a very large slowdown, you would see all these markets coming down together, right? So Europe has been interesting. Again, similar to when I was only on January 20th, year to date, Europe's been looking very good versus the U.S.
Yes.
But that hasn't persisted for many, many years, right? So I'm curious about Europe, I would say, looking to maybe add to the portfolio. But at this stage, I was going
to say, it sounds like you're going to wait a beat.
Yeah.
Okay. We hope we answered Renata's question. We do have to take a quick break. Richard Orrell is hanging around, portfolio manager at Croft Financial Group, taking your questions today on exchange-traded funds. We're back in a moment. Questions. Mohammed wrote in with a question saying this: Hamilton Enhanced Multi-Sector Covered Call ETF. Can you please let me know if you would recommend it for an RESP account?
Okay, thank you, Mohammed, for the question. So this is, as its name suggests, multi-sector. I like that. That's very good. But in the name, you'll also notice there's the enhanced. Now, enhanced tends to mean leverage, again. And as I mentioned before, I'm not the biggest proponent of leverage. Leverage is great when markets are going up, but obviously not so good when markets are going down, right? And so I think it depends on the age as well of the beneficiary as well. So in RESPs, you've got to make sure you've got that timeline correct. If they're nearing university or college and need that money, then you've got to be very safe, right? Because you've built up a nest egg. If they're younger, then yes, you could go it. So I couldn't endorse this, but it's not it's an okay choice.
Yeah, I guess I always presume people are starting those accounts when the child is quite young. But you're right, they could be starting them later, just before sort of high school, and they're going away to university, which that timeline really shortens, and you got to think about it.
Exactly, Marielle.
Okay, let's go back to the phones. Nazar is on the line. He's calling from Scarborough, Ontario. Nazar, what's your question today?
Hi, Marilla. Hi, Richard. May I have your thoughts on iShares S&P TSX Composite High Dividend Index ETF? This pays a good dividend of 5.53%. However, it basically tracks the whole market, and you will see a lot of volatility. Would you recommend switching into a good single security instead, which pays a dividend, and I can buy it at a good price? Thanks for taking my call.
Thank you.
Hi, Nazar. So to answer, I guess, the first question last, the last question first is, no, I wouldn't look at this time to go single security, right? Like when you're getting these bouts of volatility, ETFs, although there are ones out there that can take, a drawdown as well, usually they're much better.
They're more stable.
More stable, right? Because you've got that basket underneath of different equities. I think the broader question here for me is, where do you see the Canadian economy going? And as I said last time I was on the show, I'm not ready to go there because of these tariffs. We've got a new administration also in Canada, and obviously an election, likely to coming up soon as well. So I'm still avoiding Canada. I've been largely in the U.S. for many years, and still avoiding for now.
Okay, and we should have touched on that in the beginning. We do have a new Liberal leader that will be ushered in. We likely will have an election sometime in the spring or summer. How much does that sort of put back any plan to come into the Canadian market for you?
That's a tough one without diving into too many of the political details and things like that. I mean, the current administration has been very protectionist with Canadian, lack of takeovers, that type of thing. Canada's become somewhat uninvestable at a corporate level. So we'll have to see how those policies change under the new leadership.
Got it. All right, let's go back to the phone lines. Ray's on the line calling from Pickering, Ontario. Hi, Ray.
Oh, hello there. Hi, Richard. I'm about 5 years from retirement, and I'm looking to supplement my, pension and RSPs with a monthly income fund. And I recently purchased a VDY, the Vanguard VDY monthly income fund, and I was just wondering if you think that's a good choice to, as I'm approaching retirement, for a monthly income fund.
Thank you, Ray. Can you tell us a little bit more about it?
Okay, well, Ray's a fellow Pickering native, so I appreciate
Shout
that.
out for Pickering.
Shout out for Pickering, yeah. So the VDY, high yield dividend, it's going to have some equity volatility. I don't know where exactly it stands on the components, whether it's kind of geared more towards low beta and that type of style. So, yeah, Ray, it can be a component of a portfolio, and can get up maybe into the 20% range of a 100% equity portfolio. You got to bring that down because Ray obviously won't have 100% equity, but as a kind of, you got to do some math there.
Yeah.
But yeah, so I'm good with the VDY as an option in a retirement portfolio.
Got it. Okay, let's go to an email then. Marco had a question about an unhedged ETF. When dealing with ETF based on U.S. markets, does it make sense to own the unhedged version of an ETF when the Canadian dollar is strong versus the American, and switch to a hedged version of the same when the Canadian dollar is weak? Is it worthwhile to go back and forth that way?
I've read, timing here is a big issue. Or the challenge, I guess, to get it right. Last time I was on the show, I thought, the U.S. dollar had been strong. I've been going with unhedged versions recently. So really, Marco, what you want to focus on, and it does get a bit confusing even for myself, is which one do you think is going to be stronger, right? So if you think we're in a period where the U.S. dollar will be stronger, you don't want to hedge. But if you think we're in a period where the Canadian dollar is going to be stronger, then you want to move to that hedged version. And you're right, Mariela, you touched on it. Sometimes it's just best not to even worry about it and just let it play out.
It depends on how much time and energy you want to put into watching, right? That's the other thing, because then you have to be aware all the time. So let's move on to another question we have. This one is coming from Ryan. It says, hi, I'd like your guest's thoughts on VCE as a long-term hold. Broadly speaking, would you prefer adding new money to Canada, given how expensive the S&P 500 is?
So good question, Ryan. I kind of mentioned earlier, I'm not really looking. I'm always looking, but I'm not putting money to work in Canada right now. The question of valuation often comes up. There's a lot of people that love valuation. I don't mind valuation, but I'm not going to say, hey, I can't invest in this till the PE comes down to this multiple, because some things stay expensive for longer. Good quality companies and franchises that are inside these ETFs can stay very expensive. Costco, for instance, MasterCard, Visa. If you don't purchase these companies at some point, you're going to miss out on some good opportunities, right? So Canada's cheap. I think we touched on that a little bit earlier. Some of the policies, we'll see how that changes. But I wouldn't just make it purely on evaluation, and I'm more worried about how these tariffs impact. I think if these tariffs maintain at the levels they are, 80% of our exports are to the U.S. It's going to be, pretty devastating on the Canadian economy. Yeah,
it's going to be a hit. Okay, we are going to take a quick break. Back with more of your questions in a moment, as well as a look at our guest past picks. That's coming up. Welcome back. Time now for past picks. Richard was here in January, and it was the first time you were on, I guess. So our past picks are not that old, but we'll take a look at them anyway. So this was from January 20th, but I think the first one, the American markets were actually closed. So the numbers are from the 17th of January, and it's Invesco S&P 500 GARP ETF. At the time, why did you recommend it?
Well, I like the U.S. market, as I mentioned, and I do like the strategy, right? So it's growth at a reasonable price, and unfortunately, growth has been discounted here, right, by the market. So we touched on this earlier. It's a collection of stocks, right? So it's 75 different stocks, and I watch the components as well and try to read their earnings and understand what's going on, because you got to know. I mean, as a portfolio manager, knowing your product and what you're invested in is absolutely key. And if you look at some of the holdings, say like DEC, DECK, it's down substantially, probably 40%.
Wow,
right?
okay.
They're the maker of UGG brand, as well as a few other brands.
Australian.
Yeah. So this has got caught up in the growth story. I still hold it. I'm going to continue to hold. Obviously, the drawdown isn't great, but when I've coupled it with the other parts of my portfolio, I'm going to stick with it. Got
it. Okay, let's get to the next past pick, which is again from January 20th of this year, so a month and a half or so ago. This was J.P. Morgan U.S. equity and the Premium Income Active ETF. Why did you recommend this?
Well, so I took some other equity out of my portfolios, and I wanted to put in an instrument with a covered call strategy on it, our call writing strategy. And that really was to insulate against what we're seeing right now. So, it's done all right. It's distributing, a very tax-efficient income if you're not holding it in a registered account.
Okay.
And I still think the window for covered call writing is open, right? When you get the VIX and the volatility spiking, it can provide that protection to keep you in the markets. Obviously, if markets turn and recover rapidly, it won't participate. But right now, it's keeping you in the market.
Got it. Okay, and then let's get to one more you recommended in January. That was the TD US Equity Index ETF. And at this point, everything's sort of a little down, but obviously markets have been hit pretty hard. Tell me about this one.
So it's a really solid ETF, quite low cost, has a bit higher concentration on some of the higher tech names. Okay. So to be down 6%, this happens a few times a year, usually, right? So I'm still holding. Okay, I've actually added some on this pullback here because I believe those companies are so cemented in some of the in technology and some of the other companies that you're still going to see good growth and opportunity in that sector.
Yeah, and everything's taking a beating right now, so we're looking at it that way as well. Okay, we are going to take another break, line up some more calls for Richard. We're back in a moment. Stay tuned. Welcome back to Market Call. Richard Orrell is in-house talking about ETFs. And before we go to the phone lines, I just wanted to ask you, we talk about diversification and the need for that, especially when things are going up and down the way they are now. When you talk about diversifying, can you give me an idea if you like ETFs that are sort of differentiated by sectors or ones that have different things in the basket? Well, how do you sort of look at something and decide this is the one for you?
Right. So great question. I always go back to the asset allocation, right? So you've got to have a certain amount of your portfolio in fixed income.
Okay.
For a few years there, maybe 2018 right through to 2021, there wasn't much return on fixed income, right? And then 22 was a really tough year because rates were rising, and your fixed income portfolio didn't provide any ballast, right, against the equity markets. it's different in today's market, right? Rates in the U.S. are 4.5%, and in Canada 3%. And if those rates drop, your fixed income portfolio is going to help, right? So as long as you haven't gotten away from that asset allocation too much, and that's a conversation you should be having with your advisor, your portfolio manager, to make sure you're in line, then your portfolio is not going to be seeing these big red numbers that we have on the screen here, right? As far as selection for product, yeah, I narrow it down. I kind of look at how much U.S. equity, do I want this equity, that type of, where I want those, and then I will start to research on the products and figure out what I'm comfortable with. Same thing on the fixed income side, right? Where do I want to be? Do I want to be on the long end, on the short end, somewhere in the middle? Credit quality, all those questions, right? So then you go through, and then I think there's over 1,500 ETFs now in Canada.
I was going to say, it's so much more challenging for the ETFs because there's so much more research involved if you want to invest.
Yes. So there's a lot to look at. That's why some of my picks are relatively new, but you're new ETFs that they've just been issued, but you're taking and you're being familiar with the strategy that they've been running, right? So they're not, I wouldn't worry about that from a risk perspective.
Got it. Okay, let's go back to the phone lines. Tom is on the line. He's calling us from Kingston, Ontario. Hi, Tom. What's your question today?
Yes, hello. I'm wondering about a pure play in mineral for something like uranium. So I'm looking at something like URA, or if you had perhaps another recommendation.
Thanks, Tom.
Okay, so Tom, URA, uranium. A lot of Cameco, I know, is actually in this one. I've actually held it in one of the pools that I help manage. We were looking for growth of electricity and nuclear to power all these data centers and the AI boom. That trade has come unwound quite heavily. So some of the U.S. utilities that are involved in that space have dropped significantly. So I don't know where URA is exactly today, but if that's your angle, I don't mind it as picking it up on some weakness here. And then but I will recommend that you don't hold, say, more than 5% in a 100% equity portfolio. So you got to dial that back even when you're dealing with a mixed portfolio of some fixed income and some equity.
Okay, so 5% maximum.
Yeah.
Got it.
Yeah.
Okay, let's go back to the phones. We have Gulam on the line. She's calling from Toronto. Hi, Gulam.
Hello, how are you?
Good, thanks.
Okay, my question, some time ago, when there was a lot of hype, I put some money into HMMJ. Since then, they've had a reverse split, the stock's gone down, and I'm not sure what is happening with that ETF. I'd like your recommendation on that, and if anything's going to change with the Trump administration coming up. So I'll hang up and listen to your question, to your response. Thank you.
Thanks, Gulam.
Well, Gulam, I don't know what, I haven't heard anything. It doesn't seem to be the top of Trump's agenda today, but that doesn't mean it isn't tomorrow, right? Oftentimes it just moves on to the next thing. So, it's a bit of a tough call here. The industry's been saturated, hasn't done very, very well. I think there's other places that your capital would work better. That being said, it could pop any day. If it does, I would probably sell and look to move on.
It's been saturated and oversaturated, right? And do you imagine that some of those players will now disappear because they're just not getting the sales in?
I don't know. I don't look at it enough to make a call like that. But I do agree with the caller. Until the U.S. moves on it, I don't think you're going to see. And it's very complicated. I know it's run at the state level and the federal level. It's a very complicated story. So again, just too much uncertainty, I would avoid.
Got it. Okay, let's go back to the phones. Amy's on the line calling from Toronto. Hi, Amy.
Oh, hi there. I understand somebody has asked a question on the preferred shares, but I just want to know in general, is that PL? In the past years, I make a little bit small gain with the capital gain and the interest rate, because recently the interest rate is so low, and I'm very safe unless to do something GIC, but it was so low that I just can't hardly put myself in invest. So do you think the preferred shares is a good alternative? But I understand they can be more volatile. But I look at the trend, it seems like they were kind of a steady in the last years or something, or actually sort of inching up. So and listen to your opinion. Thank you very much.
Thanks, Amy.
Okay, Amy. So yeah, preferred shares always seem to be a hot topic. We've got a lot of them issued in Canada. You really have to think of them as a long bond. without the security of being in the fixed income world, right? So, they're just right below that in the equity structure of a company. Rates are going down, so you're seeing them rise. I would think, my guess is that Canadian interest rates continue to fall, especially with tariffs. They're going to need to boost, investment and get money out there in the market and liquidity. So I'm okay with preferreds. I've held them before. I don't currently hold them. But you just have to know, again, what you're getting into. And
what kind of timeline are you saying? You're saying hold them for the longer term.
Well, they're essentially a long-term bond, right? So they react as interest rates move down, they'll go up, but they react that way. And so they can be used for either short-term or long-term in a portfolio. But yeah, I like them as part of a group of fixed income. I wouldn't be saying, hey, I'll take all my fixed income and put it into the preferred shares. Yeah.
Got it. Okay. Let's go back to the phone lines. Devesh is on the line calling from Calgary. Hi, what's your question today for Richard?
Hi. Thank you for taking my call. I would like to know about TEC, TEC, TD Global Technology Leader Index Fund, and I have started recently dollar cost averaging. So I was wondering that is it the right time, and it's dropped in the last 1 month, it's dropped by 11%. So is it the right time to get in, or is there any other similar ETF, similar to TEC?
Okay, thanks for your question. So over 3% down, I guess, in the last few years. Sorry, up 54% and 3.5 down just today. So people are wondering when is good to buy in. And you said if there's not a lot of volatility here, should they be watching? Is now the time sort of to scoop something up?
On the longer term chart there, you see 2022 is a bigger drawdown, right? And I talk a lot in percentages. So, it looks like it's drawn down maybe 10 to 12%, right? So as historically as drawdowns go, you're probably getting into the range where, you could, it's an opportunity. Devesh mentioned a very powerful word, which is dollar cost averaging, right? For longer term investors, that's a very good thing. If you're just kind of constantly buying and constantly going along and somewhat ignoring what's going on in the market, you're going to do very well over the long run. It's harder because you want to be able to get in at the bottom and those types of things, but I still think technology, global, very, very long-term, lots of tailwinds.
Okay, so take smaller bites over a longer period of time.
Correct.
Got it. Okay, good to know. We do have to take a quick break, but we'll be back with more of your questions in just a moment. Stay tuned. Thanks for joining us here on Market Call. We have Richard, who has sent an email to ask our Richard a question. Let's go to the email. He says, looking for a guest's opinion on ENCL. What is ENCL?
So ENCL is the Global X Enhanced Covered Call Oil and Gas.
Got it.
Okay, so Marielle, as I mentioned before, you got that. It's a long name.
Yeah.
You got that enhanced in there, so it's leveraged. There's also, I guess, an unleveraged version called the ENCC. Okay, so when I've looked at these. One of the other partners at my firm has the ENCC in his portfolio. So as we have a review committee, we make sure everything looks good, and we cross-reference with each other. So I've reviewed it, and between the ENCC and the ENCL, over the long run, there's not much difference.
Okay.
Right? So I would tend to gravitate more towards the ENCC because it gets me away from that leverage situation if I'm going to play oil and gas. And as I've been kind of sound like a broken record, sector bet, I'm probably not going more than 10% of a portfolio, of the equity side of your portfolio in this security.
Got it. Okay, let's go back to the phones. And Harry is on the line calling today from Tavistock. Hi, Harry.
Hi there. My question is more of a general one about covered call ETFs, the advantages, disadvantages. When would you use that vehicle in the markets? Anyway, I'll hang up and listen.
Thanks, Harry. Okay,
Harry. So covered call rating works well when there's volatility and markets are going sideways to slightly down. Okay. It provides that cushion. If the market is ripping and it's going higher, then obviously you get called away from your positions and you miss on the upside, right? So that's the strategy. I think the window is still open for covered calls. Obviously, Marielle, if the market gets really, really, low or down, draws down heavily, that wouldn't be the time to add a covered call strategy because usually your worst days are also coupled with your best days, right, in the markets.
So you would take it on the slide down.
Yeah, you could still employ covered call, although obviously today could be the low, right? So I'd be wrong. But if it's looking to kind of play that volatility, right? And to those call premiums and option premiums become income, and then it cushions the blow of the underlying portfolio.
Okay, so it's complicated, and you really have to sort of know your stuff as to when to jump in.
Well, you can always have a component of covered calls, writing that strategy in your portfolio, but over the long term, it is going to drag because it underperforms up markets, and historically the market goes up, S&P 9.5% a year, right? Like over long time frames. But there are moments, and I think a moment is now with all the banter and all the back and forth on tariffs and those types of things where the strategy can work and be add some value to a portfolio.
Got it. Okay, let's go back to another email. This one is from Peter. He says, what are your guest thoughts on ZFH as a component to an income-based portfolio? ZFH.
Okay, so I understand the ZFH is a floating rate high yield fund or ETF by BMO. I have a similar ETF that I'm using by Mackenzie, the floating rate. It's higher yield for sure. So it's been okay. The problem is I'm seeing right now is you're getting distribution, but your net asset value is also sliding at the same time, right? So as the economy looks at slowing down, will companies, will they be able to keep going, right? And I think they will, but we just don't know. And so you're getting that distribution, but you're also seeing the credit quality have an impact, right? Your prices are coming down as well at the same time. So net, you're not actually making, gains, right?
It took quite a dip in August of last year, I guess, as well. I'm just wondering if you've noticed that anywhere else, or is that specific to this ETF?
We did have, we actually, I think we had a fairly big pullback in August. If you go back and look at it on the charts, you can see it drew down.
Yeah, there we go.
And then it bounced right back up.
Okay, so it was short term.
Yeah, again, there's so much going on. I can't remember pinpoint exactly or.
No, I was trying to remember what was going on in August. Yes.
But yes, there was some. Any even in the S&P 500, the Nasdaq, there's a similar pattern.
Got it. Okay, let's go to another email. This one from Trevor. It says, Evolve Global Healthcare, largely a basket of U.S. healthcare stocks. Would this be a safe place to park some money in these confusing times? American healthcare, also complicated, not the same as sort of Canadian healthcare when you look at it. So is that something you would invest in at this point?
Yeah, the stocks tend to be a bit lower beta, right? So as the market is sliding, it's not going to slide as much. Like you said, Mary, it's complicated as well, right? I mean, I want to highlight one member in there is probably UNH, United Healthcare. This unfortunate event that happened to the CEO of one of their divisions. And then on top of that, some of the pricing practices and things like that. Again, it's a very complicated problem, right? So I think healthcare overall has some defensive characteristics. And some days when markets are sliding, you'll see it actually catch a bid because it does have that defensive nature. So as far as on the equity side, yes, I think it has those defensive characteristics, and I'd be okay moving into either that or the XLV. I
was going to say, are there similar products you would suggest that somebody look at in comparison?
Yeah, so the XLV, that's the U.S. version. There's probably something on the Canadian side that you can look at. But we use the XLV if we're going to make that tactical sleeve
I'm just wondering, and I know you said you don't sort of tend to invest Canadian at this juncture. When you're looking at health in the U.S. and Canada, what's the primary difference you're looking at?
Well, the problem in Canada is just not the diversity. So healthcare in Canada goes back to that HMMJ. It's usually marijuana companies. So you're not getting the exposure you're looking for, which I assume is healthcare, hospitals, instrumentation, those types of things, right? So you're looking at it's a very different sector, and there's just not the breadth and quality of the companies in Canada.
Okay, we do have to take a quick break here on Market Call. Don't go away. Our guests will share top picks. That's coming up next. Invesco S&P 500 Equal Weight Income Advantage ETF. And why Invesco?
Yeah, long name for you there, Mariella.
Absolutely.
So really, to explain to viewers, last time I was on the show, I picked JEPI, right? So it was the covered call writing across the broad sector of the S&P 500.
Okay.
And this instrument's very similar, but I couldn't pick the same one, so I picked this one instead, right? So it's just purely a substitution. It has it's equal weight S&P 500, and then it has that covered call writing component on it to kind of soften the blow. As I said, I think the window for covered call writing is still open. That could change 6-9 months down the road. Maybe you want to head back towards straight out equity. But right now, I like covered call, and I don't own it obviously on the screen there, but I do own JEPI, which is quite similar in nature.
Okay, so if you're watching, as you say, for the window and when you can jump in, what are you watching for? What are people looking for?
Well, I'm looking for confluence of a few different factors. So, I don't have the crystal ball.
Give me an example.
Right. So I'm looking for those days where the market, shows some strength late in the day. Right. So sells down, capitulation type activity. We didn't touch on this yet, but investor sentiment is actually quite low already, right? And so that's another sign that maybe this is in the latter stages as opposed to early stages. Things like the put-call ratio that are out there. Like once you start to see some of these kind of things come together, that's when I would be looking to make the switch.
Got it. Okay, let's go to your next top pick, which is a BMO one, MSCI USA High Quality Index ETF. What do you like about the BMO?
So it screens for a few good quality characteristics, high return on equity, as well as stable year-over-year earnings growth, okay, and low financial leverage. So I think these are characteristics that all work going forward. Again, it's a bit of a pullback here. I own a bit. I bought some more last week, I think. So again, I'm looking for the longer term, right? My goal is retirement. A lot of clients are still working towards that retirement goal. And so I want to be focused on high quality companies. These ETFs also rebalance every 6 months. So they can either right size a position if it's run too much, or they can bring in new additions and remove some of the ones that are lagging. So over time, they've outperformed maybe S&P 500, right? 3-year, 5-year time frame. And so it adds a little bit extra to the portfolio.
Okay, you mentioned that they're also sort of a better bet as far as less volatile than if you're just going into equities. And I'm wondering if people are getting nervous, because they're kind of getting nervous across the board, I think, just generally. And they're watching sort of the pullback of even 1%, 2%, something like that. Should they worry? Should they be concerned?
I mean, it's money, right? So everyone takes it it's an important topic. A lot of times these conversations should have happened, right? Like,
you decide your risk point.
Yeah. And sometimes I deal a lot of percentages, and then clients will say, hey, what does that mean, dollar value? Oh, I can handle that, right? Like, I've got a portfolio of X, and if I can handle Y swing, that's okay, right? Because you didn't get to that spot without taking that risk in the first place, right? Life changes, goals change, outlook change, your outlook for your life changes. So you've got to be making those changes. I don't know if a market downswing is the best time, but it's an opportunity to also have that conversation.
I think sometimes it's a reality setting in, right? You might say, I'm comfortable with this, and then when you see the number drop or your money drop, it becomes more real to you. So you're saying if you haven't done it ahead of time, now might not be the time to dip in because the sentiment has changed so much?
Well, it can be very emotional, right? And you want to take that out of the equation. You want to be more rational about that. So that's where you have to. We see risk questionnaires all the time where people answer, "Oh yeah, I'd be fine with that," and then you have a 15% drawdown, and
and then you get the phone calls.
Yeah, they're very, and rightfully so. They should call, but yeah, seeing something on paper and then actually having it experienced in your portfolio is a very different thing. So again, just refresh the conversation.
Got it. Okay, let's go to your third pick for today, which is Vanguard Canadian Ultra Short Government Bond Index. So why do you like this one?
Yeah, you think I'm trying to get paid by the word here, but anyways, the Vanguard. So it's a holding spot, right? It's Treasury bills and Canadian bonds from 0 to 12 months, so very very near short duration. As you can see there, it just kind of goes up, pays out the interest and income, and then it keeps plodding along. It will not yield as much if rates continue to drop, but right now it's just a spot to hold some extra cash if you were, if you could take advantage and take a little bit off the table, put it in here for now and maybe wait for this for the volatility to subside.
When you are, as you mentioned, maybe 5-7 years to retirement, what would you look at? We get a lot of callers who are sort of in that bracket, right? They're approaching So they've already done some investing, but they're now approaching those last years and they want to do something with the money, maybe change it up. What do you suggest for them?
Well, you're right. It's a question we get all the time. It's a very nerve-wracking sequence of returns matter the most at that stage, right? Because if you have a really bad year in the market right as you retire, it can be very hard on you. So prepare your portfolio, make sure your asset allocation is right, and go from there. I mean, that's all you can do is talk to an advisor, talk to a portfolio manager, and make sure you've got everything lined up.
And asset allocation, what do you recommend?
It's totally
different for everybody.
Yeah, it's different for everybody, right? But I would say, as you're nearing that retirement, don't move all your money to fixed income. You still need that equity component to protect against inflation and purchasing power of your wealth and your money. So make sure you keep a solid equity component in your portfolio.
Interesting, because a lot of people do want to just move to fixed income. They want to know what they're getting, right?
Some people can, if that's, if you have a plan and that's your lifestyle and you say, hey, I'm good, no problem, you can do that as well. I mean, it's an individual's choice.
Got it. Richard, thank you very much for coming in. Appreciate that. We do have to let it go there, but we do want to take a look at the markets as we go to a break because they've been hit hard today again. So on this Monday, 298 points down on the TSX Composite, so 1.2%. The S&P down 129, but take a look at the NASDAQ. It is down 655, almost 56 points, or 3.6%. So we're still kind of getting hammered today with a lot of tariff uncertainty and everything else. That's it for Market Call today. Thanks very much for joining us. We'll see you again tomorrow.